Well, welcome to our April High Rock monthly video. I'm Scott Tomlinson, and with me is my colleague and partner, Paul Tepsich, High Rock's certified financial planning professional. Bianca Tomlinson is working on a part-time basis for the time being, so she doesn't have any daycare at the moment for her almost 3-year-old son. So she is on part-time and not joining us on the call. Well, we hope that you are all doing well. We know from our conversations with many of you that some of you have returned from traveling and have been isolating, and we wish you all the best of health and hope that we can all get to the other side of this virus relatively unscathed. We also want to send a shout out to all our clients who are on the front lines, and certainly for that, we send you our thanks. You will see some temporary reductions in portfolio value when you get your quarterly reports, which we expect to be sending out next week, and we'll continue to stand by to chat with anyone who would like to discuss your portfolios in greater detail. And so please do not hesitate to get in touch. Well, March was a dramatic month. Volatility spiked to levels that we have not seen since 2008 as uncertainties surrounding the coronavirus grew. Financial markets, as I think most people are aware of, were hit with some significant selling. Really, even the Canadian bonds were slightly lower too. Certainly US equities, global equities, and Canadian equities, Canadian preferred shares, and Canadian REITs all were hurt. Fortunately, we have very little exposure to Canadian preferreds, and Paul, zero exposure to Canadian REITs, right?
That's correct. And one more thing I'd add on this chart, Scott, is that there was about a week and a half period mid-month where you can see the green line in Canadian bonds, and this was U.S. Treasury bonds and government bonds around the world. There was about a week and a half period in there where everything went down. So normally when all these risk assets like stocks go down in value, we rely on our government bond position to balance out our portfolio, and the government bonds typically go up in price when US stocks and Canadian stocks go down in price. There was a 1.5 week period in there where people were selling everything, including U.S. Treasuries and gold. And the reason for that is complex, but we'll just leave it at there was massive, and still is, massive demand for U.S. dollars around the globe. That somewhat abated, and government bonds started doing much better in the back part of the month.
All right. Well, thank you for that insight. Certainly, a year ago, and between a year ago and now, there's been a really significant change. But the fear and greed index actually at one point in the month hit down at a level of 3. We're still registering extreme fear, but certainly at one point there was a lot more fear. It's come out of the market a little bit, and I think a lot of it has to do, Paul, and you can expand on this, and we'll talk about this a little bit more as we get through our presentation here. But a lot of it has had to do with the stimulus that is coming from both central banks and federal governments so far, and definitely that part where you were showing the bonds had all lost value. A lot of that had to do with the clogging up of the financial system, and the central banks seem to have, for the most part, alleviated some of that, correct?
Yeah, absolutely. There are all kinds of different programs. There are some statistics out there, but between the U.S. government, federal government, and the U.S. Central Bank, the Federal Reserve Board, or what we call the Fed, they put through as many or more programs in place to free up financial markets in 3 weeks' time than they did in 6 months during the global financial crisis in 08-09. So they did, and it did free up a fair bit of very short-term funding issues commercial paper programs, overnight loans that banks make to each other, and of course to corporates as well. But it totally seized up trading. It was unbelievable. And Scott, this CNN Fear and Greed Index too, they don't show it, but if there was a 2-month look back just before this big downdraft in assets, I think it was at 98 or something.
Yeah, I'll actually, there's a chart to come that will show.
Oh yeah.
So
right.
We can have that discussion in a moment for sure. Well, as you all know, we have been positioning our portfolios to be defensive, not because we saw the coronavirus coming. We certainly didn't see that, but we certainly felt that back in at the end of 2019, even slightly before that and through January, that markets were extremely overvalued. And you can see down in the lower right, red circled is our basically a cash equivalent for our portfolios. It's actually somewhere between 20 and 25%, again, depending on the client's portfolio and their specific strategy. But at the moment, we still have a fair bit of cash. And Paul, we are continuing to try to find opportunities, but we think there may be some more to come. So we're being cautious, cautiously optimistic, but still cautious at the moment, right?
Yeah, absolutely. And we can go through our what we've been doing lately and why. We probably, it's fair to say, Scott, that average cash equivalent position 5 weeks ago or so, just before this crisis erupted, we were probably in the high 20s to low 30% in cash. So it was extremely protective. And then the other thing I would add about our portfolios, which still exist today, is we've had a pretty good weighting in government bonds, as you can see on the far left. You've got about in this portfolio anyway, just over 14% in government bonds. And the government bonds we've owned for the last, number of months, but certainly for the last couple of years, have been largely longer duration or longer dated bonds in the 10-year and 30-year sector in both Canada and the US. And they really help protect our portfolio a ton. We did take a little bit of profit in the 30-year US Treasury. We took about half off the table, but we will maintain those bonds for a while with what we think will, for the short term anyway, short to hopefully medium term, we will be in a deflationary environment. But at some point that could change, and we will reposition our government bonds to be shorter duration and less term to maturity, where they will be less price sensitive.
Excellent. And obviously, we remind everybody that we manage risk first. So certainly that has been one of the reasons why we've had a higher cash weighting. I think it's definitely helped our portfolios relative to the benchmark, and that benchmark being a 60-40 benchmark over on the far right. You can see some of the other, that's in the top chart, but otherwise you can see some of the other benchmarks up there. But again, as always, we bring your attention to the return per unit of risk that we take, and that comes out in the chart below, and certainly puts us instead with taking lower risk, but at the same time trying to maximize the potential returns. I think we do a great job, and over a multi-year period, of course, that's where we shine. Sometimes we'll underperform in especially strong markets because we're a little bit more conservative, and sometimes we'll outperform in down markets. And I think what that does for our client portfolios is helps to lower the volatility, which means that we recover more quickly from a down market and get back about the business of getting growth into the portfolio more quickly in times of down markets. So again, any comments on that, Paul?
Well, I have one short comment. The other thing about sitting on cash and cash equivalents as we were going into this crisis, it was protective and we didn't have a massive drawdown. I can't tell you anecdotally, Scott, how many friends I have, and some of them are clients of ours, have congratulated us as our average client over the past month was only down about 7%. How many people have said, oh my God, I've got friends and family that are down 30% because they were 100% invested in equities. And, sure, over a long period of time that may come back, but the problem is they may get despondent and they may get shaken out or sell out of their positions or their portfolio. And I've seen some of that go on the past month too. So we've all got enough going on with our lives that we want to get rid of the volatility. But the beautiful thing about holding cash is we've been able to buy and average in for the market on the way down on big down days, big downdrafts in the market. And when you're fully invested, you can't do that. You just have to sit on your hands. So we've been pretty lucky.
Yes.
And smart.
I think a combination of both. As we know, we continue to monitor and position ourselves for the long term and our clients. So we are, again, cautiously optimistic as we move forward, but we also want to make sure that when we do add some of that cash, that we're doing it as at the best values, so we get the best long-term potential out of it, and that's really something that we're always focusing on. Okay, so what's keeping us up at night? Well, certainly the situation in the U.S. with regards to the coronavirus is definitely keeping us up at night. We haven't seen yet anything close to a peaking of the coronavirus curve there. It's starting to peak a little bit in Europe, not so much France perhaps, but certainly in Spain and in Italy. So we're hopeful there that they've found ways with which to lock down their countries and flatten the curve. But again, the fact that the U.S. is continuing to rocket higher is disconcerting, and that has led into some really significant numbers in jobless claims. The recent jobless claims number was staggering. Today's number was staggering. And
Scott, we should just mention these are weekly statistics.
Correct. These are the weekly jobless claim data, and in fact, we're probably not going to see these translate into an unemployment number until we get the data for April, which will be at the beginning of May. But we are fully expecting somewhere in the vicinity of 15 to 30% unemployment at some point in the United States. So that is a bit unnerving at this juncture. Remember, when people are unemployed and they don't have confidence that they're going to have a steady stream of income, they're postponing any purchase decisions, especially in consumer discretionary spending. But also at the same time, businesses are stopping investing and obviously stopping hiring. So there's this sudden stop to the economy, and the big uncertainty is about how long this is going to last, right?
Yeah, absolutely. So how and the previous chart you were showing about the coronavirus curves in Europe kind of flattening, Spain and Italy most notably. But the problem is how do you get the economy back to work? When and how? And the last 24, 48 hours, I've come to the conclusion that I don't think we're going to go back to a normal way of living where we go to bars, restaurants, sporting events. That's not going to happen until there's a vaccine. Actually, I was just on a CIBC's deputy chief economist had a call yesterday, and I listened to a replay today, and he kind of agreed with that. I don't think we get, workers going back to the shop floor in Ford and GM. they're unionized. They're not going to go back unless there's a vaccine, and they are totally safe. So I think this could, from an economic point of view, drag on longer than we think, and that keeps us up at night for sure.
Yeah. What else keeps us up at night? Well, we have seen significant movement lower in equity market pricing, but what we haven't really seen, and because of all the uncertainty, a lot of corporations aren't pre-announcing earnings for the future. They've literally pulled them off the table. So when we look at one of the metrics we use to determine where there's value, we don't have the full picture. So we look back to see where value was in 2008, 2009, and even in 2011. There's still some room to the downside, as Paul was saying, and we do have to keep some powder dry in case we do get back to some of those levels.
Yeah, and this is only one metric to look at the market. Like there's the Warren Buffett one, Scott, which we could maybe show at some point, or we could use it in a blog, is the market capitalization of all the U.S. stocks. I think it's the Wilshire 5000 versus the U.S. GDP, and it's still ridiculously expensive.
Yeah.
But there are all kinds of metrics to look at.
Yeah, there are. And this is one we commonly look at. So we just try not to confuse or get too in too much detail, but just to give an idea of what the potential is. There's certainly some potential for greater value from where we are right now. And share buybacks, Paul, you want to talk about those?
Yeah, this is kind of interesting. We just saw this chart this week, but I had seen it before. The red dotted line are non-financial corporates. So these are really corporations who are buying back their own stock. And if you look over the last 10 years, corporates have really been the only net buyer of stock. So, and I can tell you anecdotally, but you're now seeing it unwind over the past month. A lot of companies have gone out, and these are, large, big companies like Apple being one, that have issued investment grade corporate bonds because there was good demand, because people wanted to get incremental demand from an investment grade bond over top of a government bond, which didn't yield much. So they were happy buyers of, let's just say, Apple investment grade bonds at a thin spread over treasuries. Then Apple would take that money, the proceeds from the bond issue, and go out and buy their stock back. But that happened all throughout the world, and certainly, as we can see here, through the U.S. equity markets. And it really did ramp up. If you look at institutions, households, institutions would be life insurance companies, huge money managers like BlackRock and Fidelity, et cetera. Households are retail investors like you and I, every individual, and the rest of the world would be, it could be pension funds from around the world, other money managers, et cetera. But really part of what drove this crisis is leverage, but it happened at the corporate level. So what we're now hearing, Scott, and why this is important to us, and this kind of rumbling started a year ago with certain Democratic Congress people saying share buybacks should be eliminated. Well, now after this, what we're seeing is share buybacks in many cases may be. So the 8 money center banks in the U.S., which would be JP Morgan, Citi, B of A, et cetera, they have foregone all share buybacks for the second quarter. And I would not be surprised if they did that through the balance of the year. The UK and European banks are doing the same and cutting dividends, which our Canadian banks did not do in the global financial crisis. So the ramifications of share buybacks being eliminated is enormous, in my opinion. It will definitely limit the upside in the stock market. Anyone thinking that the S&P 500 is going to do a quick V-shaped recovery and get right back to 3,400, where its record high was 5 or 6 weeks ago, I think is mistaken.
Yep, and I don't disagree with that. I think, you know, from an economic perspective and a stock market perspective, our recovery will likely be more of a U-shaped with a fairly long U to follow.
Right, not quite an L, but a long flattened out U.
Yeah, a long flattened out U. Anyway, let's talk about bear market retracements. You wanted to briefly mention this too.
Yeah, this is kind of an interesting chart from Rosenberg's note this morning, but without going through each line, you can really just see the S&P 500 on the left, the bear market point decline that we saw, and then the prior bull market point gain. So on line one in the Great Depression, you can see on the right side, the bull market had gained about 14 points, and then on the left side in line one, you can see it dropped 26 points. Far right, it's almost 186% loss. If you take all those periods of bull markets and bear markets, and you take the average, it's about a 83% loss, or even take the median, it's about a 70% loss. So that's top to bottom. So, I mean, if we look at the S&P 500 today, don't have it in front of me, Scott, but we're probably down about 25, 26%.
Yeah, somewhere in that vicinity.
Right. So now the other caveat to this is that there was never fiscal and monetary stimulus put in place like there is today. So that will help out with some of the downside. You know, I don't think we're going to drop 70% from the highs when we find the ultimate bottom in U.S. stocks. Maybe we drop 50 though. But there has been a fair bit of stimulus, both monetary and fiscal, put in place, somewhere to the tune of $6 billion, and they're probably writing another package. And the whole question, Scott, I think becomes two comments that would have all these talking heads on TV looking for the bottom in equity markets. I think two things. Number one, we'll find the bottom when credit markets start freeing up. They start actually trading and behaving, which they are doing a much better job of today than they were 2 weeks ago. But they're still somewhat nervous. So that's a little bit problematic. And the other signpost could be where we see oil, hopefully today, finding some sort of base and bottom as well, because oil is a really a key barometer for the economy, because it right now is going through both a demand shock like every other company and commodity in the world, but also a supply shock.
Yeah, excellent. Thank you. Well, that takes us to a more positive note, and let's follow through with that a little bit. But you were talking about this fear and greed index over time, so it did manage to get down to about 3. It's bounced back a little bit, but the opportunities that it has provided in the past, they're definitely something that is a positive. We will get opportunity. We'll have a chance to put our money to work. We just have to be a little bit careful about how we do that, right?
Absolutely. And we've been buying, as I said, at the beginning of the year, this thing was up at 98. It's crazy.
Yeah.
I mean, that was the worst month for financial markets ever. But we have been buying on these big downdrafts and dips for sure, and we've probably placed, somewhere between 8 and 10% of our cash into both our global equity model and our tactical model.
And we talked about fiscal stimulus, so we don't need to get into it in too much detail, but there's definitely some great support from the government level, and that should help put a little bit of stability into both the Canadian and the U.S. economy. And then, of course, as you mentioned, we're getting all sorts of monetary stimulus from the Bank of Canada. The Bank of Canada, first time ever buying bonds and doing quantitative easing. And that certainly obviously helped the bond market in the latter part of the month, right?
Yeah, for sure. It did help free up short investment grade bonds, enable them to trade a bit more and better. You could see dealers willing to take a bit more risk, and the bid-ask spread tightened up a little bit. So that was definitely helpful, and we'll see if these programs continue at pace.
Yeah. All right. Well, in case some folks hadn't received the update to our 5th anniversary event, we did postpone it. It was originally to be held April the 29th. We've moved it back to September. And we will have our special guest, David Rosenberg. And Paul, just very quickly, I think we have to give a bit of a shout out to Rosenberg, because he is one of the researchers that we follow very closely, and certainly his ability to point some of the behind the scenes economic data out to us has certainly helped us as far as being a more conservative, taking a more conservative investment stance, right?
Yeah, absolutely. He's well, quite frankly, I know you read some other strategists, but he's the only strategist I read, and quite frankly, I don't get to him every morning. We subscribe for his morning note. I don't read it every morning, but I worked, for those that don't know, I worked at Merrill Lynch with David many moons ago, and had an excellent relationship with him back then, and we've maintained a friendship over the years since we both left. He started his own firm, which I had kind of consulted with him a few times on what it would take, and he started that Jan 1, and he's just doing a great job. But he is a really critical thinker. He's a great guy, so I'd highly encourage. And Scott, it's probably fair to say too, we don't take what he says as gospel. We don't have on every position he recommends, and we have other positions on that he may not be on side with, but we have to manage. He doesn't manage money. He's a strategist, and we do have to manage money. So we do have some different thoughts, but he is a great critical thinker. And those that haven't seen him or heard him speak on TV, which he's on a lot, I highly encourage you to come out to this event if we are able to gather on September 16th, which I'm not totally sure we're going to be able to do. But it's right across from our office at the Albany Club, it's a beautiful room on the 4th floor. So highly encourage you to do so if we are able to gather and if you are able to make it.
I'm going to take the cautiously optimistic note and say that I'm pretty comfortable that we'll all be there, and hopefully celebrating the other side of the large degree of what the coronavirus has presented with us with. Anyway, whoops, sorry. That's it for April. Again, I encourage anybody who's wants to talk specifically about their portfolios to get in touch with us. We've had a lot of great conversations. I would say that when you get your quarterly summaries, you may want to have a bit more, get a bit more insight in your specific portfolio. So please never hesitate to get in touch. But wishing you all safety and health. We'll look forward to getting back together for this monthly video at the beginning of May. Until then, on behalf of Paul and Bianca, again, stay safe, stay healthy. Okay.